Good afternoon, everybody. Welcome to the TraderMerlin show. It is, in fact, we're getting into the tail end of the week. It's your Thursday edition, one I think many of you are excited and been waiting for, simply because of what happened with the FOMC meeting. I know that I don't think there's enough talk about bonds and really how they work, the implications of the FOMC meeting, raising 75 basis points, and a topic that I actually got all giddy about talking with Bill just before the show, which is, how much does this actually cost the government? It's funny because you and I look at each other and go, okay, our cost of capital just raised by 75 basis points, fine and dandy. But, you and I might have disposable incomes or budgets or net worth that might be in, let's say, the $1 million range or $2 to $5 million range. Okay, this impacts us. But what if you're in the $1 trillion range? This really starts to add up big time. So anyway, we'll talk about that today. For many of you who are new to the show, my guest today is a regular on the program. I try to bring him on once a month, and the reason for that is he is one of the more insightful people in the bond markets. He's got over 40 years trading bonds. He actually used to tell stories about how he'd run around and from a phone booth and making bond trades for the Fed funds window, I believe was something like that. I'm talking about none other than who I think is the real king of bonds, Mr. Bill Addiss, joining us to discuss what did the Fed really do. I had to take out the profanities out of that opening statement there, but what did the Fed actually do? Joining me from the East Coast today, we've got Mr. Bill Addiss. How you doing, Bill?
Heck of an introduction. Thank you very much. I'll try and live up to at least half of it.
Oh, come on. I look forward to this probably more than my guests. I know it's kind of weird, but the guests on the program are always so excited to have you on because they learn about bonds. I learned so much more myself. So you are an educator extraordinaire. Just even the 45 minutes you're going to be on the show with us today. What's new in your world? Anything exciting before we dive into the Fed?
Getting back out on the road finally. After 2 years of living a Zoom existence like the rest of the world, client base is now opening the doors. The financial firms have wanted butts in the seats for a couple of months now. So back on the road again, and that's a lot of fun. I was mentioning I was out on the West Coast there doing business and pleasure last week. It's good to be on the road again.
Are you singing music with your friends? On the road again.
Me and Willie are heading down the road.
Nice. Well, obviously yesterday was probably a fairly exciting time for you. I know that you probably are a nerd for it like me. I love the rate announcement itself, but I literally took a piece of paper and I'm writing down questions from the reporters and the reactions and what I thought was interesting. So let's start with your take. Obviously the topic for today is, what did the Fed really do? Walk us through your perspective of what he did and maybe what are some of the underlying details that most people aren't thinking about.
Yeah, couple of things, and the intro should read, and not what did they do, but also what they didn't do, and we'll talk about tapering, because that was a topic that somehow got lost in the sauce. And obviously, the Fed raised rates by 75 basis points, and I just want to quickly run through it, because when the Fed raises rates, they raise a lot of rates, and just real quick, the one we focus on is the Fed funds rate, and that should be the one. That's the interbank rate that banks borrow from each other. So the Fed sets a range from that. So they set a range of 3 to 3.25%. And now the Fed also raised the discount rate. That's the rate banks can borrow from the Fed. The Fed is the lender of last resort. The Fed also raised the interest on reserve balances. This one we've talked about in the past because it drives me crazy. The Fed pays the banks to do nothing with their money.
I wish that people would do that to me.
Yeah, I know. I don't get that offer. But actually, we kind of do, and I'll talk about that next.
Ooh.
You and I don't, but us money managers do. Right. But you're right. The Fed will now pay banks 3.15% to just let the Fed hold on to their money. So that's interest on reserve balances. And the one that actually impacts your audience the most is what's called the overnight lending facility, the repo facility. See, the Fed is out there offering to money managers, if you want to lend us your money for one day, we'll pay you 3.25%. And most of your audience, I know, has money market funds. Mm-hmm. And this type of investment is the leading vehicle that they buy. So the good news out of all of this is on your cash balances in your brokerage accounts or in your money market investments, you're finally starting to earn some interest there.
Right.
Thanks to the Fed. That's the only good news out of all of this. So the 75 basis point hike was expected. What I was looking forward to finding out more, and it didn't happen, is the whole issue of tapering.
Right. Well, hold on. Before we go down that route,
I'm sorry. Yeah, I can
you
keep
went through a whole
talking.
bunch of topics really quickly there.
Sorry.
No, it's good. I just want to get some clarity on a couple because we'll definitely talk about the tapering. I think that's going to be of major importance going forward. But you kind of went through four things here. The Fed funds rate. And you mentioned, that this is a rate, well, there's multiple rates, but the rate that banks are being paid to keep their money at the Fed.
Right.
Maybe you could explain a little bit about what is the incentive here? What is the economic value for that in paying a bank to keep their money at the Fed?
Good. Great question. And what it comes down to is presently, banks don't have what is called a reserve requirement. In normal times, banks are required to keep a certain percentage of their deposits on deposit at the Fed. That's called the reserve requirement. Well, when the pandemic hit, one of the things the Fed did is they made the reserve requirement zero.
Which is insane.
Is insane, right? Because at the time we have the most risk in the market, the Fed's response was, well, let's lay out even more risk in by saying to the banks, you don't have to keep any reserves against your risk.
So let me just to put that in a very simple layman's term. Every single person that's watching this right now, if you're in the United States, you have money at the bank, your bank is not required to hold any of that. They can lend it all out. This is what puts us in such financial danger. This is the fractional reserve banking system, and that's done to help incentivize lending that money out and growing the economy. However, if there's a run on the bank, your bank does not have the money. That, to me, is a huge systemic risk that has just been swept under the rug here.
Yep, huge, and it didn't get a lot of attention even when it happened back in March of 2020 when the pandemic hit, because there's so much else going on, obviously. So the banks aren't required to keep any money on deposit at the Fed. But the Fed is desperately trying to pull cash out of the bankings, out of our economy. You've played many times. I've seen the M1 chart that shows how much cash we have in our economy.
Which they discontinued.
Yes, yeah.
It's such a horrific chart. They're like, you know what? We're just not going to use that one anymore.
We're going to stop showing that.
Wouldn't it be nice that in life, if something was so bad to you, you just go, you know what? I'm just going to remove that from my life altogether. Reset button on that one. I think it's beautiful. The Fed just said, no more M1. We don't need it.
Pay no attention to that number because we're not showing you it anymore. So the bottom line is we got way too much cash in the economy, and that's part of what's fueling inflation. So the Fed, economics 101. So the Fed is desperately trying to pull cash out of the economy. So what they said to the banks is, look, you don't have to leave cash with us. You don't have a reserve requirement. But if you choose to leave cash with us, we'll pay you 3.15%. That's not an unattractive rate.
No.
And it's intentionally done that way to try and get the banks to incentivize them to literally take cash out of the economy and turn it over to the Fed. And by this overnight lending facility, they're basically offering the same thing to corporate America, money market funds, asset managers. Let the Fed hold your money. And that's essentially taking it out of the economy. And last night, we had over $2 trillion was lent back to the Fed by asset managers and money market funds last night. So it's been successful.
So we had the Fed funds rate jumping by 75 basis points. Obviously, we could look at the forecast, but you have next month, November's meeting, sorry, not next month, but November's meeting, November 2nd, they're expecting another 75 basis points. You go to December's meeting, talking another 50 basis points. So right now there's a 65% probability that by December's meeting we'll have increased another 1.25%. Now, if we are in a situation that is somewhat dire, and I'll read some of the quotes I wrote down if I can find them quickly from Jerome Powell. I mean, he cited the weakening housing market. He talked about their goal is to moderate demand. So they're trying to destroy demand. They're trying to prevent people like myself and you, Bill, and all the people watching to not go out there and spend, to not go out there and buy because that's creating inflation. Now, ironically, that's what drives the economy, so it's kind of weird to see it happen. But we're already seeing a slowdown, and I can bring up chart after chart after chart. I'll bring up a couple here for you. Everybody, you guys know what happened to the S&P. Here's your S&P on a monthly. We're seeing a pretty significant decline. We can also see that on the NASDAQ. We can also see it in other markets, except for the dollar. If we see another 1.25% increase by the time December comes around, I got to ask you, how much damage is that going to do, given the fact that housing market has already started to roll over? I think you and I talked before the show. What was the national average for a mortgage right now?
Yeah, just announced this afternoon. We're up to 6.6% on this national 30-year fixed.
6.6%. So for those of you who locked in, under 3%, go pour yourself a nice, tall, frosty beverage and cheers yourself, because you may have locked in at one of the lowest points in the history of mankind.
Absolutely.
But another 1.25% by December, if we're at 6.6 right now, that means we could see 8% mortgages by November, which seems inconceivable, but that to me is like going to slam the brakes on. The talk is soft landing. I look at these rate increases. We've had 3 75s in a row. We're going to get a fourth and then a 50. This to me is not a soft landing. This is watching the Hindenburg go up in flames.
No, we've talked about, and the phrase I've been doing is a soft landing is about as imaginary as a unicorn, because it's great in theory, but nobody's ever seen one, and that's really the theory of a soft landing. I mean, I hate to be so mercenary about it, but what we have to understand is the Fed, without saying it, has told us they need to drive the economy into a recession.
Mm-hmm.
There should be no discussion of soft landing. They need to do it. And it's kind of the short-term pain, I guess, versus the long-term gain. But inflation, really is scary. I don't know how to express this enough. We're looking at numbers coming out of the UK, inflation running at 13%, Germany, obviously, with the energy. And that inflation gets transferred from an economy to economy, apparently with the exception of Japan, which isn't suffering from it. But that exception, inflation gets exported. So, no, inflation should scare people. I keep saying I'm a veteran of 1979, when inflation hit 14%. And in 1976, 3 years earlier, it was only at 4.6. Inflation, we talk the term rear its ugly head. It can do that. Now, I do have to say, I don't want to sound too pessimistic, because if you look, the last 2 months, we've actually seen a diminishing at the rate of growth of inflation.
Mm-hmm.
So we have to put that in.
But 2 months is, that's 2 points worth of data. We've mentioned that in this program. We talked about it several months ago. We looked at the price of commodities dropping at such an alarming rate. I mean, it was like, holy crap, how fast is cotton, wheat, and soybeans and lumber all plummeted, and you had crude oil as well. But now some of those have stabilized. In the last month, we've seen sharp increases in those commodities. So while we had a 2-month little pullback, and I love that our president says we don't have inflation. It's like, no, that was 1 month. Inflation didn't go up anymore, but that's 1 month out of the annualized rate. We could see that number start to tick back up here. So we're not done
Absolutely.
yet.
And if I could just highlight and kind of clarify something you said earlier, because I do want to make sure everyone's comfortable that, yes, the Fed is raising short-term rates. And as you said, we're looking at a rate over 4% by year end. But let's stress, that's the short end of the market.
Correct.
When we're talking about mortgage rates, that's long-term rates. And that's, as responding to different factors. And, whenever you're pricing the 10-year mortgage, 30-year mortgage, you always price it to the 10-year treasury. Yep. When you're trading mortgages, which I used to do, we'd hedge it by shorting the 10-year. There's a huge correlation there in terms of what's called duration. So we price mortgages to the 10-year treasury. And as the 10-year treasury is now at 3.6, 3.7%, I mean, it's up 70 basis points just this month. That's what's having the impact of mortgage rates.
So in the last 133 weeks, which I know is a long time, that's to the lows of 2020. I have the chart here. It's crazy to think of how much it's gone up. So back at those lows in 2020, the 10-year bond was sitting at a low of 0.333. Gotta love that. It has since risen 1,034% in that period of time. Now that we're at 3.71. And of course, guys, you understand that even at this current rate, which is 3.7%, that's still historically not that much for the 10-year, right? We could see this potentially get higher and higher, and I think that's why I keep setting off alarms in my mind is if we get back to some normal rate of 5 or 6%, and if we raise another 1.25%, yes, that's the short end of the yield curve, but that certainly is going to have an impact on this. That could push this even higher. And here's the monthly. Let me zoom out a little bit more for everybody. Look where we were at. Right? If you look back here in the 1980s, which Bill can tell you all about because I don't remember squat. I was just living in my parents' house. 15.85% on that 10-year. Remember, your mortgages are higher than the 10-year, so I don't think we're getting to those levels. But what does it do to choke out our economy if we get to 5% on the 10-year or 8%? I mean, these are huge numbers.
Yep. So talking about impact of that, there's as you're pointing out, the fact that rates are going up has many different correlations to it. We've seen it to the equity market, obviously. We see it to the currency market, but we're seeing it to sectors, real estate being a perfect example. So, these changes in rates are having huge impact to a variety of different areas. But please understand, it's being done intentionally.
Mm-hmm.
The Fed needs to put on the brakes. And, I love the fact that Powell basically said, look out, we're having a recession without actually using that word.
Yep.
The quote that I loved we were talking about is, he said, expect a downturn from the current trend, economically speaking. Well, the current trend is we've had 2 negative quarters of GDP. In the old days, that was the definition of a recession. So here we are with 2 negative quarters of GDP, and now Powell's saying, look out, there's going to be worse times ahead. If that's not a recession, I don't know what the heck is.
Yeah. One thing that you mentioned early on, and I think it definitely it should be mentioned, and no one's talking about this, is one of the talk tracks has been, you keep the dollar as low as possible. Therefore, when the government goes to pay its debt, it's paying it back with cheaper dollars, and it's much easier for it. As that dollar starts to rise and interest rates rise, the ability for a government to make its financial commitments gets taxed. Not taxed, that's the wrong word, but it puts a burden on that ability. And you mentioned some numbers. Walk me through, or at least share those with the viewers as far as how much does this impact the government's ability to pay down our debt based off of these rate increases?
This is the real problem here on a going forward basis, as far as I'm concerned, because I'll be honest with you, I'm a deficit hawk. The government during the pandemic was operating at a $3 trillion deficit, the most ever. We had it down to about $700 billion so far this year, and the government was doing a pretty good job of not overspending as much. And I guess when it comes to a government, that's the best you can hope for.
That's the best you can hope for, yep.
Yeah, so the deficit was growing at a slower rate, and that's good news. But what blows my mind, quite frankly, and I just read this from the Congressional Office of Budget, they've come out with a number that says, if we assume a 1% hike in interest rates across the maturity spectrum, short term and long term, because the government has debt all the way along that maturity spectrum. So if we assume, for simplicity purposes, a 1% rise in interest rates, that increases our deficit by $285 billion.
Wow.
That's a staggering number. So if we look, you look at the 1-year Treasury right now is over 4%. It was at 0 last year.
Mm-hmm.
So, you're looking at 400 basis points there. If we had that same move across the yield curve, you're talking about we just increased the deficit by another $1 trillion.
Wow, what's $1 trillion amongst friends?
Yeah, here, trillion here, trillion there.
So I gotta wonder, we know that there's a dual mandate by the Fed. Obviously, for those who might not know, it's maximum employment and price stability. And if we take those two side by side, right now the Fed has said, F employment, we don't care about that because we're low. He even mentioned, I think, what did he say? He said it was interesting on unemployment. What did he say? I didn't write that one down. Damn it, he had so many good quotes. I didn't write them all down. But he's basically said, we're going to throw unemployment out the window. We don't worry about that because we're so historically low, we can let that one rise. He said price stability is our main concern, so they're going to be very aggressive with these rates. And I gotta think that the Treasury Department's going, hey, Jerome, hold on a second. We have obligations, and you're totally messing that up right now.
Absolutely. I mean, and you want to have my fear scenario going back to my 40-year history. Back when we had stagflation in 1979, the 30-year Treasury had a 14% coupon to it. Mm-hmm. The U.S. government had to pay 14% to borrow money for 30 years. Those investors got 14% all the way on up to 2009 when that bond matured.
Love it. Don't ever sell that thing.
Yeah, right. Oh, God, that was a museum piece. Yeah, right. Now the government is still only issuing 30-year paper at under 4%. So on a relative basis, there's a lot of upside risk here.
Yeah. Tons and tons and tons of it. We have a bunch of different questions come through. Some of them could be rather long-winded, so I don't know if we can get to all of these ones. But Liz was asking, why define a range for the Fed funds rate or the borrowing range? Why is it like a 3 to 3 1/4? Why do they give it a range?
Because great question, by the way. I don't know if we don't get. I don't know that. Good, Liz. The reason is the Fed doesn't actually have the authority to tell banks you must lend your money here or you must lend your money there. They don't have the authority to say you must lend it at 3%. So what they tell the market is, we're going to permit the Fed funds market to trade within this range of 3 to 3.25%. And as long as you, the banks, behave yourself and trade the money within that range, we're not going to do anything. But quite often, and sometimes even daily, the Fed funds rate will actually slip above or below that range, because like anything else, it's based on supply and demand. If banks need to borrow a lot of money one day for just, maybe seasonal purposes, for whatever reasons, that rate could start to trade up. And conversely, if banks aren't borrowing a lot of money, it could trade down. So the Fed will actually come into the market on a daily basis and actually intercede and affect those supply and demand. They'll actually go in and start buying money, for lack of a better definition. So they're going to manipulate the market to get it to that 3 to 3.25%. They don't have the authority to actually mandate it, if that makes sense.
Okay. It does. I mean, and everything is going to be obviously supply and demand driven, so you do get the ranges out there. A great question, Liz. Tom, this is it was not a question, it's really a comment. It says, Jimmy Carter mentions his inflation and interest rates, and Joe Biden replies, here, hold my ice cream cone. Usually it's hold my beer, but you're right, Biden might be an ice cream cone out there. Stan, this is another good question. I'll set the stage by making this statement. When I worked for a financial planning firm, it was very formulaic on how you should invest your portfolio. It was take your age, subtract that from 100. So if you're 20 years old, subtract that from 100. That's the percentage that you should be in stocks. The rest of it should be bonds. So if you're 90, you should be 10% stocks, 90% bonds. And to me, it's a stupid way to allocate your portfolio. However, that is a historical model, because theoretically, the older you get, the more you want to remove some risk and get income stream payments, which bonds help you do. Now, you mentioned the I bonds as being an important thing, and I think that might be a great vehicle. However, understand that I think we're in a period right now of a great bond manipulation, right? We have massive manipulation of bond prices right now. They've been inflated because the Fed has been buying their own, getting high off their own supply and pushing it, and now they're selling. So two things. First, what risk factors do you see facing investors with bonds? And then to Stan's question, other than the I bonds, what bonds would you suggest investing in?
Yeah, and great questions. Your audience is really good. I'm always impressed. First off, I do think, and I have to put some background in here. I also do feel that even though we did have that brief, let's call it downturn to inflation, that inflation is still a global issue that we have to deal with. So it is my expectation that long rates are going to continue to rise. Also, the fact that the Fed is going to start tapering more, that also is going to cause long-term interest rates to rise. So I'm looking for further rises to the long end of the market. So in that case, with my expectation of continued inflation, I like inflation-adjusted bonds. And we have the I bonds and we have TIPS, but there's also corporate bonds that are floating rate bonds. Now, they're not necessarily tied just to the inflation rate, but they're tied to short-term interest rates. So in a rising interest rate environment, floating rate product, not just inflation floating rate product, can make sense. I also think, quite frankly, in terms of asset allocation, if we could go that macro, you're finally getting compensated to get into cash. If you're getting the same return on cash as you are for a 30-year treasury, I'm not seeing a lot of reason to be going out longer in maturity, right, and getting duration risk there. So shortening your maturity, taking advantage of what the Fed is doing and what the marketplace is pricing in about this rise in short-term rates, take advantage of it. Invest in that sector of the market.
And I'll bring up the yield curve for you. This is one of my favorite sites here. It's just it's an animated yield curve. And for those of you who are historians and find it interesting, as I do, you can actually click on this chart of the equity markets, and it will show you what the yield curve looked like at that moment. And this is what we were as of September 21st, so basically as of yesterday. You can see we're pretty much inverted on all of them. The short term is significantly higher. You see that 30-year. We kind of are flat between that 10 and the 30. But as Bill says, why would you even consider buying a 30-year when I can go out here and get a 2-year at a far greater rate? That's going back to this chart here that I've mentioned. Let me bring it up here, where we take the difference really to show you what that inverted yield curve might look like. Here is the 10 and the 1. You are rewarded right now 37 basis points more to hold on to a bond for 1 year versus buying the 10-year. So there's no incentive to buy the 10. And here's the 10 and the 2, which is 40 basis points. So even better rate of return just for holding the 2 year. So you're not incentivizing anybody to go out long term. Now these rates aren't that great. They still are getting better. I like your I bonds. I think the I bonds was something I never really even knew about until you brought it up to my attention.
And while we're on the topic, I do want to point out, because the I bonds last reset their coupon on May 1st. The next coupon reset is November 1st. Now, so every 6 months, we change the coupon based on the inflation rate. And I would point out, as we were just talking about, for the last 2 months, that rate of growth has dropped a bit. So I just want to warn the audience, because we've been, think these are a great vehicle, but the coupon reset in November will probably be lower. Now, again, we've got 2 more months of data before we can confirm that. But if we were to reprice those I bonds today, according to Bloomberg, the new coupon would be 6%. Now, that's still a heck of a lot higher than any treasury rate you're getting. But it does reflect the fact that CPI came down over those 2 months period. We've got 2 more months of data yet to go.
Nice. I'm sorry. I was going to actually bring up another question here, but yes, it's going to readjust, most likely lower. We'll have to see how much that goes lower in the next couple of months. I want to go to a question that came through from one of the viewers. It was a great question, and it is not what the heck happened to your hair today. I just decided not to take care of my hair today. I decided to go with the rugged look. Here's a great question from Karen. I think Karen is here today, so thank you, Karen, for this one. She says, how deep and long the yield curve, well, I guess I cut off the first words, but does it matter is really the first part. Does it matter how deep and how long the yield curve is inverted if this makes any difference or predicts how long or deep the future recession may be? So I think that this is a fantastic question, because we are in a situation where not only are we seeing an inverted yield curve, but it's seemingly getting more aggressive to the downside. And I'll show you that picture again. Here is anything below this green line. That's an inverted yield curve. And you can see the trend is your friend to the bend at the end. And it looks like it's going to keep on going down here. So what are your thoughts with regards to its impact on the markets overall? Is there a significance to how far or how long it's inverted?
Great. Another great question. I'm really impressed. The answer is yes. Great question, Karen. Because we're getting growing evidence. Now, just to give us some historical context, the whole concept of an inverted yield curve here in the U.S., we've only experienced 7 times. I mean, this is not a common phenomenon. Now, I'll grant you, most of them have been within the last 40 years. And the last inverted yield curve was in 2019, when the U.S. Treasury yield curve went inverted, even before we knew what COVID was. Prior to the pandemic or COVID, the bond market was looking at the U.S. economy saying, we see problems ahead. Now, the correlation we're seeming to get is that, yes, there is a correlation between how deep the inversion gets and the impact of the recession itself. Now, the problem is when you're measuring recessions, you can do it by time period, or you can do it by change in GDP. So with only 7 data points, we don't have a lot to work with yet. But there is really growing evidence that, yes, the more inverted your yield curve gets, the worse your recession is going to get. And even going back to 2019, before COVID hit, the yield curve went inverted, but honestly, it wasn't very inverted. Right. And people were kind of saying it's just going to be a cyclical, easy recession. And most people weren't even believing there was going to be a recession at all, let's be honest. And in fact, though, when COVID hit and the curve really inverted, that's when the market was saying, well, obviously we got a problem here, but that was obvious because we were shutting down our economy. Right.
Well, it's funny because the curve didn't invert when COVID hit. The curve, it steepened. It looked way better. And all of a sudden, I mean, you can see it here. So this is the 10 minus the 2. Basically, the 10-year yield surged, right? You saw a significant increase in that 10-year. But then right around April of 2021, that's when the 10-year started to decline. Well, sorry, the yield of the 10-year was still going up, but the short end was going up much quicker. And now we see this period of time, as you can see right now, you get 0.408% more for holding that 2-year. But what I want to show is, I'm going to zoom out. This is a monthly chart of that yield curve differential between the 10 and the 2. You'll notice some very interesting things here. I'm going to put I'll put a horizontal line on this picture. And I apologize, Bill. I know you can't see this, but
that's fine. I'm listening.
You probably know them well. I'll go to where our lows are. Let me snap this to the low that we achieved this week, which I think is right about there. You'll notice this is lower. So the inversion is deeper now than it has been since even the 1989 inversion. And, obviously the interest rates were surging at that time as well. But we've had this inverted yield curve in 1989. You can see this one back here when the equity markets peaked in 2000. the trend right now is telling us this is going to continue to drift down even lower. And I've never seen it. I've never seen it. I've never seen the magnitude this big in my lifetime. And, there's always something new coming. I do agree with Bill. I think that when you see it down here for a prolonged period of time inverted, it generally paints the picture of ugly times ahead. And if that's the case, then this picture is not pretty at all. And you heard Powell basically say, expect some pain. Consumers going to expect some pain. He also said, made a point to talk about that he's moderating demand, and he said a sustained period of below normal growth. Now, if the
that's one I love.
if he's saying sustained, normally he would say a short period of below normal growth, but to say sustained basically says I'm looking way out, and man, we're screwed.
But normal growth to me means GDP, and we're already negative.
Yes, I know.
So it blows my mind.
Yeah, it is. It's a crazy world. It's crazy to see the focus and manipulation, I guess if you would, of bond products and marketplaces. The balance sheet's another really interesting one. So maybe we can talk about that. You sent me some great graphics here where we talked about the flattening of the yield curve. Maybe we can walk through those for a little bit. I'm going to bring up the balance sheet picture. Walk us through this balance sheet because I think it's really interesting to understand what's driving this market and maybe what the systemic risks are of this balance sheet.
Cool, thank you. And this is, if nothing else, this is one of the few slides I have that has pretty colors to it. So
we like colors.
We like colors. So looking at the Fed as a corporation, which it is, right? My standard wrap: the Fed is not a part of the government. It's a private corporation, publicly held corporation with shareholders.
That should be false advertising. I'm sorry.
False advertising.
It's the Federal Reserve, and it's not a government agency.
No, for-profit corporation. So if we look at this chart going back to 2007, before we had any of the current problems that we all talk about, the Fed as a corporation had a balance sheet of just under $1 trillion. And, they're like any other corporation. Now, when they instituted quantitative easing in 2009 and they started creating and printing more money and buying bonds, by the end of that period, we had about $2.5 trillion after the first round of quantitative easing. Along comes 2011, they do more. Along comes 2014, they do more. So bottom line, what we're looking at here is a picture of the assets of the Fed. So let's pick a random year before pandemic. Let's look at 2019. What this chart is showing you is that the Fed had a balance sheet, total capital of about $4.7 trillion. And what I like about this chart is it shows you a breakdown of what the Fed owned. And you can see on the orange slice of this, that's their treasury holdings. And the Fed at this point is the largest holder of U.S. treasuries in the world. Now, what I find interesting and a little bit silly is the amount of mortgages they hold.
Yeah.
Look at that. Look at that gold sliver. I mean, their mortgage holdings in some cases years were almost as high as their treasuries. I can understand in 2008 and 9 when we first started doing quantitative easing, why the Fed felt responsible to step in and start buying mortgage-backed bonds to take some of that credit risk out of the market. But if you look back in 2009 and 2010, they weren't buying a heck of a lot of mortgages, and that was during the mortgage crisis.
Right.
Look today. The Fed's got, about $3 trillion of mortgage-backed bonds. And why today is the Fed continuing to buy mortgage-backed securities? Mortgage market, for the last 4 years has not been having a problem.
No, it's been one of the most robust segments of our economy. It's been housing.
Exactly. So why has the Fed continued to buy and support the mortgage market? Makes no sense to me.
None.
And then the blue line, just explain other assets, is their corporate bond and municipal bond portfolio. And then government agencies. So it's agencies, corporates, and muni, other bonds. Because our Fed, unlike a lot of other central banks, only buys bonds and ETFs when they do quantitative easing. Other countries like Japan are buying everything, real estate, stocks, you name it, they'll buy it.
And I think, if you look at that chart, and I'm glad you spelled it out with other assets, if that's utilities, I think we would all agree that there is a need to make sure that our utility infrastructure, water, electricity, stays online and doesn't falter. So I have no problem saying, okay, Fed, prop up, buy those bonds of utilities and keep them going. But this housing market thing, not only are they buying it, but look at the magnitude. I mean, it's an unbelievable amount. And if you go back here to 2009 when we had the housing crisis, basically this was people making bad loans. There's a whole bunch of crap that nobody wanted to buy, and the Fed's like, hey, we'll buy it. And they continue to do so. And, I always make this really horrible analogy that if I'm a patient that goes in for a broken leg, that doctor is going to juice me up with some morphine or something to ease the pain so they can put, titanium rods in my leg and get me back on track. But here we are, looking at 13 years later, like my leg has been healed for years. And you're like, hey, let's increase your dose of morphine. It's like, hold on a sec. I don't need that. There's no need whatsoever. So Margaret says MBS equals housing bubble. I will say from my perspective, this absolutely facilitated the housing bubble because it put a backstop on it. And basically everybody's to do, prices are going to keep going up because the Fed's going to keep buying. Now, my question is, what happens if they unwind? Now, Powell said specifically, his quote was, regarding mortgage-backed securities, not considering selling. They said, we're not going to sell any of it right now. But when they do, this could create real problems. And I guess I have to ask, how do you sell these things? Because...
Well, great question. And this gets us into the tapering discussion. Because understand, just to finish with the balance sheet, because just to make sure everyone's sure. So just to jump to the end. So here we are today. The Fed's got a balance sheet of $9 trillion. And $8 trillion of that is their bond portfolio. They have the largest bond portfolio in the world. Take China and Japan, put them together. We still have 400 times more bonds than they do.
Wow.
The Fed owns 400 times more bonds.
Insane.
So, it's crazy. So they've got this huge portfolio. Well, now they've committed to starting tapering, which literally means they're going to start destroying money. The Fed created money under QE. They're now going to start destroying it. So starting back 3 months ago, the Fed started destroying $35 billion a month. And that number, based on a schedule they gave us actually back in May. Back in May, when the Fed first started tapering, they laid out what was going to happen. We were going to start at 30 trillion and quickly work our way up to 90 trillion. Now, at yesterday's meeting, tapering was noticeably inconspicuous. He said at one point he'd talk about it, and then he never came back and talked about it. So what they've said in the FOMC releases that I had to go back in and get is that they are maintaining their commitment to the May schedule, which means that they're going to continue going forward to destroy 90 billion a month. Now, here's the problem. For the Fed to actually destroy $90 billion of cash a month, they're going to have to start selling some of these bonds.
Yep, absolutely.
Now, we don't know which ones. It could be agencies, mortgages, treasuries. But bottom line, the Fed, to get that 90 billion they need to destroy, they've got to start selling this portfolio.
All right. So
now, if your biggest buyer becomes your biggest seller, what happens to prices?
Right. Yeah. This is why you don't get high off your own supply.
Right.
Well,
Exactly.
yeah, let's revisit that just for a second. So the Fed starts to sell their bond portfolio. And you already mentioned that China and Japan have basically, they're still buying, but they've cut back considerably on their bond purchases.
Exactly.
So how does one entice a buyer to buy a product when there's so much of it in the marketplace, right? If you're going to start unloading bonds and there's already plenty of them available, how do you entice someone to buy this stuff?
Gee, I wonder how you do that. Could it be price related?
Or rate related?
Or rate related, yeah. Well, one has to go down and the other has to go up, bottom line. You have to start offering the bonds at cheaper and cheaper prices, meaning higher and higher yields.
Higher yields, there you go. That's what I was looking for.
This is why the tapering should result in higher yields. One of the first things we said when we were talking, the fact that the Fed is committed to tapering, just looking at that one variable, that's going to put upward pressure to long-term interest rates because of just the phenomenon we're talking about. Your biggest buyer is going to become your biggest seller.
Right. Yep. So there's a question. Here's a picture of the Fed unwinding their balance sheet, and you guys can see that they actually started unwinding back here in 2017. Right. It started drifting down and getting lower and lower, and then all of a sudden we had the inverted yield curve, and people went, "Oh, what?" And they stopped that right away. And you can see the crazy surge. This is mind-boggling. If you go to 2008, when things were just trucking along, the assets of the Fed was under $1 trillion. Right. And then, in the financial crisis in 2008, we went from 1 trillion all the way up to 2.2. Okay, so we were up 100%. Now from 2008 to 2014, we jumped to 4.4, another 100%. Now, we sold off a little bit before pandemic hit in August of 2019, right around $3.7, $3.8 trillion worth of assets, and we peaked in 2022 at 8.9, another 100%. I mean, these are types of increases that have serious impacts down the road. You're basically printing more and more and more money to buy these assets, and here we are with transient inflation that has turned into, a gang of thugs inflation.
Right. Crazy. No, if you look at this chart, it clearly shows, what we just went through with the pandemic was basically quantitative easing on steroids.
Yeah.
In 6 months, they put more liquidity into our economy than they did during the entire financial crisis of 08 through 14. Yep. Crazy. Yep. Huge amount. And M1 shows it, right? Look at all the money out there.
Exactly. Liz, great question. Yeah, we answered that one, which is, and if the Fed starts selling bonds, won't that push up interest rates? Yes, it will. Yep. You have to encourage someone to buy it. And, if I've got 3 people in front of me and I'll say, okay, I've got one of these to sell and people want it, I can demand whatever price I want. If I've got 3 people in front of me and I've got 10 of these products, the buyers get to be more selective. Now I've got thousands of these products and the 3 people in front of me going, I don't want it. Well, what if I give you this? And wait, if you act now, I'll give you 2 for 1. I mean, they're going to have to start enticing. And the way you do that is you drop the price of those bonds and you increase the rate of return, the yield that they're going to get. So expect a higher long end of the yield curve, which is good from an inversion perspective because it may actually start to bring it back to a normal yield curve, which is great. Right. However, a 10-year at 6, 8, 10, 12% has its own set of impacts for our economy.
Mortgage at the top of the list, as we've been discussing.
Yep. Here's one I have no idea about, and this might be a left field kind of question from Margaret. It says, why does the U.S. Department of Defense own government bonds?
I don't know that I'll have to do a little homework. Yeah, that's a fascinating question. I'm not aware that they do, quite frankly. But I think that's a fascinating question, and I know a resource I can go ask that question.
And I don't even know why they would. I don't even know why they would.
I don't either. Now, you said it was a government agency that did aid programs like USAID. They do have portfolios because of the disbursements they make and so on. But I can't put the Department of Defense in that same category. Great question. First, I'll confirm that that's true, and then I'll find out for all of us.
Excellent.
I'm in Washington, D.C. I know who to call.
That's right. Go down to that phone booth and get ready to – I love that story. Anyway. Tell me a little bit about your upcoming schedule. I want to give you some time to plug what you're doing and what you're teaching. I know you have a lot of stuff going on, so I had a slide here that showed some of that. So walk us through what you got cooking in your upcoming schedule.
Thank you. Yeah, the summer is getting, after the summer crazies of training all those new hires to Wall Street, the schedule gets more manageable. So we're back to a monthly XLT class with OTA. So September 27th. And what I'm going to focus on that class next week is trading the bond market. We're seeing huge volatility, 70 basis points on the 10-year in a month. We've had some days where it moves by 15 basis points. This is not your grandmother's bond market. This is a pretty volatile asset category, so we're going to talk about how to be trading that. So that's September 27th, and then we got another XLT on October 11th. I also have been remiss. We've got the new series of one-day classes, the Focus series.
Yep.
I'm going to be participating in that, and working with Larry and putting together a one-day class for that on either virtual or physical, in site delivery as well as virtual. So I hope to be part of that Focus program real soon. And then I think if you got this slide, I think is I'll plug it because I've been spending more and more time on other media, and I've now got a YouTube channel which is going very well. So you can access that on my website of aftraining.co. And I'll do it one more time, Merlin. I said I was done for the summer, but these books just keep coming and coming. There's a series of introductory level books that I was fortunate to edit a couple of years ago. And I use these for my institutional clients, new hires to the industry and so on. And I always never mention it to the OTA community, and I don't know why. So probably because it sounds very self-serving of me to promote it, because I'm the editor of the series, but the author did one hell of a job. Stuart Veal's the author of the leading textbook in America, Stocks, Bonds, and Options. So the book's available on my website at only $25 for the whole set with free shipping. So I'm basically just trying to cover shipping charges for the OTA community.
Wow. Well, I'm going to say something right now. It's embarrassing. I got to say this. I'm embarrassed right now, simply because if I look at your YouTube channel, here's Bill, William Addiss, 125 subscribers. Come on, people. I'm going to put the link over here. We can throw him a bone. I mean, from the content I've gotten from you over the past, I don't know how many years I've known you. What's it been, 4 or 5 years, something like that?
At least four at least, yeah.
you have single-handedly changed my perspective of bonds, how bonds work, the importance of them, and really the integration of bonds into the macroeconomic picture. I was an equity and forex guy, but I think if you don't understand bonds, you're shortchanging yourself, and you deserve way more than 125 followers. So I hope that you guys go out there and follow Bill on YouTube. You just click that link I put in the chat. You can hit the subscribe button. You can also, I think you click the little bell and it'll let you know when he does new videos. But there's a lot of great topics here. So awesome.
Thank you.
Yeah.
I'm trying to get into the 21st century, and YouTube seems to be an interesting way. So thank you for that.
It's a good way. It's a good way.
It's a great way.
They're already subscribing. By the time the show is done, by this weekend, you should have at least 200.
The power of Merlin. I love it. Thank you.
Well, I think that
I do enjoy your audience. These sessions are a lot of fun. I enjoy them, as illustrated by the questions we get from your people.
Yeah. Well, I mean, I think that I've managed to build a good group of people here who understands the quality, I guess, the caliber of people I'll bring on. Some people I bring on questioning their ability to trade and invest and learn from them. And if I find that I don't really care for them, I don't bring them back on again. But, there's certain people I bring on with regularity that without question bring value through their knowledge of financial markets. And I appreciate everything you've done, not just for OTA, but even, teaching kids out of college. They're going to go work for Bear Stearns, not around anymore. But, you do a lot to help educate the world the right way. One weird question.
Sure.
How come you never worked for the Fed? I could see you being a Fed official. I think your understanding of the markets warrant it.
Great question. And the career path was, 30 years with Lehman Brothers and their legacy firms of Hutton and Shearson. So I kind of went through all those mergers and evolutions. Right. And I did actually spend a lot of time at the Fed when I was at Lehman because of the trading that I was responsible for, the auctions and so on and that. So I had a lot of interface with the Fed. But I got to be honest with you. Fed doesn't pay as well as the investment banking firms. So, there's certainly a financial issue there. But now I have the benefit of, I work at the Fed. The Fed is a client of mine. I train at least 4 times a year at the New York Fed. Yeah. They're a client of mine. So I get to enjoy it that way.
Well, I guess it may not pay up front, but if you're smart, like politicians, being a politician doesn't pay. However, if you know that you're going to be raising rates tomorrow or in a week, build those short positions. Oh, that's right. The Fed's not allowed to trade and invest their portfolios. Oops.
Tell that to Dallas and Boston, right?
Exactly. Oh, anyway, I would much rather have you there. I think you could do a very good job. I would actually trust the assessment of economy and trust that you've read the data versus what I'm getting from our current administration. But I'll leave it at that.
And I don't mean to sound like a shill, but I got to tell you on a personal level, when I spend the time I do over at the Fed, I will give them credit. There's some really smart people over there.
Yes. Now, there definitely are.
You might not agree with, some people might not agree with certain things, but I got to tell you, there's some really smart people over there.
No, I absolutely agree with that. And it's honestly, it's a job. I can be a Monday morning quarterback and sit here and go, Powell screwed up and what an idiot. His tie was horrible, but I wouldn't want that job. That's for damn sure. Yeah. All right, Bill. Well, hey, thank you so much for coming on. I appreciate it. On behalf of all of our viewers here, I'm sure they enjoyed it as well. Learned something interesting every time you're on the program. So thank you so much, and look forward to maybe even joining your XLT. It might be a fly on the wall at your upcoming session.
You've done that in the past, and we always appreciate it. And let's do this again next month.
Sounds good, Bill. Thank you so much.
Best to everyone.
All right, take care.
You're welcome. Thanks.
Because that was Bill Addiss of Amherst. Oh, the website, I'll bring that up here for you real quick. I had, where was it? It was Amherst. I thought I had it up here. I turned it off. So I will bring that one back up for you guys. I don't know why it disappeared on me. So sorry for that one. But it's Amherst FT, I believe. Yes, AFT training or aftraining.co is where you can get more information. And the YouTube channel. Some of you guys subscribed. Honestly, you're going to get some great information there. So Bill is just always awesome on this show. Okay, it is Friday. I got to go through the end of the day. So here's what we have cooking for tomorrow as I'm going to wrap up here because I got a bazillion things to do. Apologize if I didn't get all the graphics set for today. But for the 23rd, for our Friday session, a lot of manufacturing and services numbers coming out for around the world. You can see them there for the European Union. You've also got France, Germany, and individually reporting early in the day. When I mean early, like right after the crack of midnight Pacific time. You also have retail sales numbers for Canada, and then for the U.S., after the markets opened up 15 minutes after they open, you have flash services and manufacturing PMI numbers, and then a very interesting announcement happening later on in the day. As you guys can see down there near the bottom, Jerome Powell will be speaking again, and that is going to happen at 11 a.m. Eastern Standard Time. So what can happen there is volatility in, let me make sure it's 11 a.m. It's, yes, no, it's actually, that's 11 a.m. Pacific time. So excuse me. That is an important one because obviously he likes to juice the markets, if you will. It seems to be very reactive to what he says. Tomorrow he'll be in Washington, D.C. giving a, it's called a Fed Listens event. So who knows how impactful that will be. But just know at 11 a.m. Pacific time, he is going to make those announcements or give a speech, and that could create wild, wild moves. So that was going to do it for me for today. I hope you learned something. I hope you enjoyed that. I'm certainly not the purveyor of doom and gloom. I'm one that analyzes the markets, looks at the data and says, okay, I have reasons to freak out. And then you just kind of do, I'm not freaking out. I'm just going to put myself in a position to hopefully capitalize on downside moves. So my moves today was a bit of put selling. I did sell some puts today, protecting some positions I had, and we'll see how that all transpires. Not very confident. I did kind of think that by tomorrow we'll see things slow down a little bit, maybe a little bit of a bounce going into the weekend, but I could be completely wrong. Get out of your positions before Powell tomorrow. Yeah, I'm gonna keep mine open. It's a nice rate of return today because of the nice big down moves. There was some very nice premium being paid for put options, so I'm fine with that. We'll collect that premium and hopefully keep building those accounts. If you guys have anything you want to discuss on tomorrow's show, I do not have a guest. I will have a nice tall glass of whiskey for tomorrow, that's for sure. If you have anything you want us to discuss, send it in at TraderMerlin@gmail.com or put them down below the YouTube channel. That's an easy way to get in touch with us, and at least us, like it's a team. Get in touch with me and get your comments or questions or topics addressed on the air. Now, one last piece here I want to look at, because we talked about this yesterday and I told David I would give him a little bit of a shout out. If we look at the intraday chart of the British pound, it was actually the Japanese yen. He was looking at the Japanese yen as a potential short opportunity. And we talked about it, how it was rallying up, looking like it might break this overhead supply at 145. It did so, and then absolutely just slammed back down here with a huge move on that British pound. And he was like, oh, I said 145. Well, yep, we did that. We had, to me, what is a classic fake out breakout. Right here you have this ascending triangle we talked about. It ripped up, got some people in long, and then completely screamed the other way. I hate when markets do this. Unfortunately, it happens all the time. But a nice big move up there and then ripped back down as they made their FOMC. They made their rate statement yesterday. And I can bring up the calendar here so we can all see exactly what they said. I'll bring it up for you. And there is the chart that was totally predicted, staying right where they're at negative 0.1%. So nice moves out there. All right, cool. Like that data. Okay, you guys are talking options. All right, that's going to do it. I'm going to wrap up. 53-minute show today. Hope you guys enjoyed it. Love Bill Addiss. You got his YouTube channel. If you have not subscribed to it, I put the link in the chat a little while ago. Some great free content and value there from Bill Addiss. I would encourage you to check out that one. He does sessions here, but he goes deeper in some of those topics on his YouTube channel. So hopefully you guys enjoy that. That's going to do it for me. Hope you guys have a great day tomorrow. I will see you on Friday, which is tomorrow. Send anything you want to talk about to our YouTube channel or to TraderMerlin@gmail.com. Take care, everyone.